Hello everyone, it's me, the Boss Hog. This week we've got a bumper week because we've got 2 for 1. Was ill with the rest of my family last weekend, so sorry about that. But we've got some big moves this week. Pretty red, I'm not going to lie. So I'm going to talk about some of my bigger moves, how I'm feeling mentally, and etc. Let's do it. Alright, so I'm not going to sugarcoat it. It's felt pretty brutal this fortnight, especially the 16th. That day was the worst day, which actually just came like 3 days after my previous worst day. So in a week I had my 2 worst days ever. I mean, this is 11.5 grand on a 100k portfolio, right? So pretty significant, and yeah, didn't feel great. To be honest, I did just want to spend 30 seconds talking about that, because in terms of not feeling great, I did a couple of things. First of all, along with Discord, we all kept each other updated in terms of our dividend progress. So of course that's been going relatively well, including my own. So that felt good to take a step back and look at the income aspect of the investment. Also as well, I had a look into several of my larger holdings, went on to investor calls that I hadn't been recently, made myself feel good, basically reinforced the fact that I still liked my holdings, and sort of reassured myself that my portfolio is okay, even if it's getting pretty beaten up at the moment. And also here, keeping perspective, I think was quite timely, just because well, first of all, I actually have enough wealth to be able to lose 11,500. A lot of people don't have that kind of money. Also as well, at the end of Thursday, and again I was feeling pretty beaten up, my daughter, who is 2.5, brought home a Father's Day card, which sort of reminded me why I got into this in the first place, right? To think about that future planning and to kind of stop living day to day. So that was welcome. I'm not going to lie, that kind of chiseled away a little bit on my stone heart. So from that perspective, that's been my general approach. Obviously I haven't been enjoying it, but again, I likewise as well as been reading up on the companies and listening to those, listening to sort of other YouTube channels, talk about the fact that there's never been a 20-year period where the market has lost money. That's my investment horizon, more or less. So again, that kind of stuff as well, just to reinforce the fact that it's probably going to be okay, even though for me, like, this is the worst I've seen it since I started investing for about 1.5 years now. So yeah, just a few things that I've personally found quite helpful. And I have to say, when it came to Friday, I'd have enough time to sort of decongest, and then I was back to kind of hoping it continues for another couple of weeks at least, just so I can put next month's pay into it. So that was my my emotional roller coaster, especially after the last week. I have been adding more capital. I am slightly running ahead of the curve at the moment. Specifically here, I'm 20 days ahead, so that's 4 weeks effectively, right? Because the market's open 5 days. So yeah, got a little bit of buffer here in case we get a bill or something through, just etc. So I'm putting as much money as I can as fast as I can, effectively. Lots of trading this week. So the last time I did this video, I had 0 sells for the first time, I think, since I started investing. But this week I definitely made some big moves. Obviously we've got the 3 companies to talk about, but there were others as well, so we'll get to that very shortly. And last but not least, just a couple of fairly small dividends this week. The Home Depot one was actually quite nice. I'd kind of forgotten about it. I only owned Home Depot for like 3 weeks, but with my profit to sell plus the dividends, I actually made about 5% from 3 weeks, which, considering the market at the moment, actually feels fantastic. I do still like Home Depot, but it held up quite well. And with the rest of the falling market, it was starting to look a bit expensive, even though I do think it's a real quality operator. So that was my reasoning there, as we'll get to in a second as well. Anyway, that summary aside, let's have a look at my buys this week. All right, so quite a long list here, but I just want to focus on the top 3. They're my thumbnail for a reason. You can see here that they're real outliers compared to the rest of the buys. Things like Apple, Microsoft, I'm averaging into a little bit more this week. You'll see why on the sales very shortly. Likewise, things like Games Workshop and T-Row, I still believe in the long term for these companies. So, but again, they're relatively small compared to the 3 big movements that I want to spend a bit more time talking about. So first up is MPW. Now, I'm not sure I've ever spent so much time researching a company as I have with MPW. For anyone who's been following me, I've been actively looking to de-risk my portfolio, so it might look odd for some people who have followed, maybe some of the bearish sentiments. But I've spent a lot of time on my due diligence here, basically. For me, I think the bear arguments are really overdone. Just a couple to talk about here. Steward is their largest tenant. They represent about 18% of their revenue, but remember that that's across lots of hospitals, and no hospital consists of more than 2% of the revenue within Steward's portfolio. However, even worst case scenario, if Stewart did hit the wall, MPW have had an instance of this before. A company called Adeptus, they had like 57 hospitals and they completely fell over. So worst case scenario, in MPW, because they own the assets, they have a lot of protection in terms of bankruptcy. They were able to, sell a third of it, rent the other 2/3, and basically made like a 17% profit out of it. So assuming Stewart was anywhere near like that, and again, like it wasn't like the Adeptus's assets were particularly crown jewels or anything. It just made me feel okay. Like even very worst case scenario, which again I don't think is going to happen, but let's say Stewart did hit the wall. I have a lot of faith here that MPW have enough protections in place and enough fallback to be able to weather that, even though it would cause a distraction. I think it's overdone basically. And likewise, as MPW has been growing, Stewart as percentage of their business has gone from 30 to 18, and I expect it to continue to fall. So of course that's still a very large customer. I don't want to downplay it, but yeah, I think the whole Stewart thing is a bit overdone. Likewise as well, though, some people point out that MPW is apparently unique among REITs in the fact it sometimes takes equity stakes in joint ventures and or loans at commercial rates, money to companies that it's also renting to. Now, first of all, that's not true. Other REITs do that. So I think that's not right. And also specifically, it's the more niche REITs that tend to do that. So, you're not really seeing that from a company like Realty because they're so diversified that isn't really what, they don't have the expertise in a single niche to be able to do that. When you look at the likes of Alexandria or Vicky or, MPW, and there's a few others as well. You find that the more niche REITs are more likely doing this, and likewise as well, even if you have a problem with this, which personally I don't, MPW in their latest earnings spent a whole page laying out exactly what this looks like, and it's $1.5 billion, so not massive positions across their whole equity and loan position compared to the size of the business. And a lot of the loans are at sort of between 4 and 8%, which feels perfectly fine. Obviously the inflation is inflation, but it doesn't feel outrageous. And then there's a lot of sort of like options and joint ventures that potentially could yield very nicely. And it didn't seem unreasonable to me. Like, yeah, Stewart are also in that, by the way, and they're about 400 million, I think, of that 1.5 billion. But there's also many other notable large healthcare providers in that MPW believes it's advantageous to invest in. And likewise, they produced instances where they've done it before and were very profitable in it. So I think the overall bearish sentiments here are sort of being caused by some short sellers, by a lot of articles in one of the newspapers, Wall Street Journal, that's the one, and generally I think a slight misunderstanding of what it is. This is a fairly niche REIT. I mean, there is no other pure play hospital REIT, but for me I think it's pretty misunderstood. I don't really have a problem with a lot of what it's doing. Yeah, there's some governance stuff, they probably don't need as many jets as they have. That seems a bit wasteful. But overall, I think it's fine. The other thing as well, just to highlight, is that like most REITs, they obviously grow by selling shares. And I thought it was very telling that in their latest earnings update, they specifically said that they have no plans at the current level of share price to be selling further shares. They don't feel it's necessary. They have enough cash. They could free up other cash if they wanted, as well as banking. And they just believe that the share price is materially undervalued. So I thought that was interesting perspective on that as well. So for me, I think, although I'm not going to claim that this is completely without risk, I think the fact it's trading on an AFFO of 12 is just too low compared to even like the healthcare REITs, which do tend to, they won't trade on the same multiple as a data center REIT. But for me, I think the risk reward here is clearly beneficial for the reward, and I'm buying super heavily at the moment and basically following it down, and I've added significantly to my position over the last couple of weeks. So I'm still pretty red on this, obviously, but feel really good about it as a balance. So that was my rationale here. Huntsman I got back into in a big way. This is still my best performing stock ever. I did really well last year when it went from like 24 to 36, made like $5,000 profit. I'm now back into Huntsman, like I say, in a big way. I've got 200 shares. I think the business is improving all the time. It's trading at forward PE of 8. I think it's a good long-term industrial stock, specifically because it's exposed to a lot of areas that should benefit from any kind of like technological change. It produces things like lubricants for wind turbines and electric vehicles and that kind of stuff that make them run more efficiently, which again should be in high demand. Also, as well, it's got now a solid dividend and buyback history. It's not like you can go back super far like you can with some of the, the dividend aristocrats. Like Huntsman has gone through a difficult period relatively recently, a few years back, as they ditched some of their low margin underperforming stuff and moved into higher margin stuff. So it doesn't have that kind of easy to read story that a lot of sort of what I would class as small to medium dividend growth stocks have. But, again, if you look at the buybacks over the last couple of years, they're starting to become significant. Likewise, well, it's a 3% dividend at the moment, which is solid. They've spoken about the fact as well that they believe that their share price is also materially undervalued, and they're looking to add to their buybacks, very clearly expressed, which again should be good. And for me, because I get taxed on US dividends, just 15%, but still a tax, I actually quite like buybacks as a way to improve my profit on a company, just because I don't get taxed on capital gains. So that feels really good. So yeah, I like what I'm seeing here. Basically, you do have to dig a little bit, but especially as one of their newest factories gets up and running this year, I think again I'm expecting to see a bit of an increase in their earnings. And last of the big three here is Macron Micron. So this wasn't originally planned to be a particularly large holding for me, but it's definitely up there now, above 3% of my portfolio. I'm quite happy with my average at the moment at 64, even though it's very red because, it's now at 56 or whatever it is. But to me, this is a company that's got significant upside. I think a lot of people are like, I don't really know why, but semiconductors seem very out of favor at the moment. To me, it's like, well, hang on, like chips are in everything, everyone's buying them, like there's a shortage. I don't entirely get it. I think in some semis there's an element of sort of maybe it was overpriced, or maybe what it was doing if it's like Nvidia, right, and the crypto is obviously under pressure at the moment. That can kind of make sense, but I don't really get it for companies like Micron. And for me, if anything, this is a company that should become less cyclical. I can kind of take or leave its telecoms exposure, to be honest. I don't think it's anywhere near the best in that space, and it's only growing in the mid single digits, so that part of the business I can sort of take or leave. But where I get really excited about this is the storage, and specifically for data centers, which are becoming just an increasingly important aspect of infrastructure. Also, as well, the storage element is becoming like an increasingly important and less cyclical aspect of that infrastructure. So I think Micron are in the storage space the best. I think that's at least a credible argument to make from at least my relatively layman technical understanding of it. And to me, it just now looks like value, basically, at these kind of levels is a very clear buy for me. So that said, I think in general I like the semi space at the moment. I'm also been buying Amco and ASML. But I think there are lots of affordable, good long-term semi plays, and yeah, Micron for me is becoming a clear number 2. I mean, it's still miles behind Amco, which is a top 5 holding for me. But Micron I really like for the reasons I've just discussed. So right now, like I look at these 3 companies and I just see a great value, good entry point for the long term, and in some cases a bit misunderstood, I think. And I actually feel relatively relaxed about holding these positions, just because I think they look good value, and again, I'm kind of quite happy buying value, especially when it's not like a risky turnaround or something like that. And I get some of the bearish arguments for MPW, but even then I think they're pretty overdone, and so on. And I guess just to round off with MPW, as a Brit, or maybe philosophically, people don't want to invest in businesses that basically are seen as privatizing healthcare. I don't really have a problem. I worked in the NHS for like 7 years. Private companies have been working with the NHS for ages. The important thing is just whether it's free at the point of care, right? That's basically it. But private companies working with public bodies doesn't concern me at all. And obviously it's different in America, to be clear, like that there's private companies working with private companies in many instances. But I have no philosophical issue with this. I think, it's providing a service. and healthcare is a competitive field. America, although I think it's got expensive healthcare, I mean, I think that's unquestionable. It also has some of the best in the world. And hospitals, when they look to free up money for things like expanding and so on, one of the best things they can do is sell their assets, basically, right? And MPW is a niche, basically the only one, but it certainly has a competitive advantage. And, you know, this is a company that's also expanding. I mean, it recently bought 4 hospitals in Finland, which is hardly known as, you know, kind of a capitalist private sector NHS provider. So, you know, it's kind of very quickly expanding to give it that geographic reach as well. So just to round off with those, but yeah, I like all 3 of these, so that's why I've been buying more heavily than others. Okay, now onto my sells. All right, so I want to talk about all of these fairly briefly though. So I'll start with Phoenix, where I sold just over 1/3 of my holding, more or less flat, which I know obviously isn't a tremendous return, although I have got a sizable dividend for this company. For anyone who doesn't know, this is a life assurance business primarily, although it's pivoting into sort of wealth and pension management. I just think it's slightly undervalued. Probably, I have a 7.20 share price, although I'm a little bit out of date. But it does also have an 8% yield, which is lovely. They're extremely conservative as a company as well, just because of the nature of their background in life insurance. So yeah, I'm fine with Phoenix, but I decided that there were better plays. And to be honest with you, I mean, Phoenix were basically sold to finance MPW, HUN, and Micron, which are all in the same portfolio that I have. So for me, if I look at MPW, it now has the same yield as Phoenix and gives me diversification, geographic including as well, right? It's a US holding instead of a UK one. So I was fine on a more or less like-for-like basis, but I do think MPW is more significantly undervalued, like 40% undervalued at the current levels. So actually probably more. So that to me was fine. It's more or less a like-for-like in terms of the income there. Huntsman I kind of like because it's, again, it's my only industrial at the moment, but I think it's kind of one of those cleaner, more modern industrials. It's making a lot of chemicals, I appreciate, but, you know, a lot of its products have value in that kind of move to cleaner stuff, which again won't happen tomorrow, so I think it's fine to have that long-term play. But again, I think it's an improving business which is exposed in all the right areas, and again, it's increasingly good quality. And Micron, you know, it has a very small yield at the moment, but again, I think it's significantly undervalued, and I think it will become more important as things go. So it was just a chance for me to pivot, diversify, take a very small profit. I think my average for Phoenix is like 620, so selling at 621.5 is more or less break even. And just as a reminder, by the way, the averages here, they include anything like stamp duty and stuff like that, you know, on UK shares, most of them you have to pay. So this is my kind of total. Next up is JP Morgan. Now I did sell this for a small profit, and, you know, selling in the 120s doesn't actually feel that great to me for JP Morgan. I think it's like a 145, 155 kind of share. It is the most expensive of the big 4 American banks, but I think it's the best. So, you know, for me, it's like, again, I'm trying to move away from just value, but I also sort of saw an opportunity with this. So first of all, this is also in my portfolio with MPW, Huntsman, and Micron. But what kind of swayed my decision, as well as being able to take, like, again, like a 4% profit, is that my financial slice is very big, especially before I sold out of a couple here. And also I'm building positions in T Rowe and Huntington Bank shares. So I just felt like T Rowe gives me that kind of holistic American economy exposure, and Huntington Bank shares is a bit, I mean, of course it's different. It's a regional bank, but, you know, in the middle of the S&P, so it's hardly tiny. And again, how Huntington Bank shares kind of fits more with my aim this year of buying medium-ish companies that are already profitable and should give me good exposure. So Huntington also has a big fat yield at the moment, and I'm fine with their regional exposure. Obviously more risk because it's regional, but potentially more reward as well. So all that said, I just felt like I was fine actually selling JP Morgan. It probably wouldn't have been my first pick, you know, if the market wasn't so red at the moment, but again, it just felt like when I could take a small profit and put it into things that I think are better as an investment case, then I did just that. Speaking of financials, so I also sold out of Aviva. So I've mentioned these before. This is a UK listed insurer. It's gone through a bit of a turnaround and much improved cleanup of its sprawling business over the last couple of years. They did a special relatively recently to reward shareholders. I had originally expected to keep Aviva for a bit longer just because the company's committed to a 15% dividend pay rise. But, you know, I sold out of here just in the low £4, which I think is about fair value. And again, that was really just to buy a few companies in my other portfolio, so my wife's ISA, that I quite like the look of. So actually T-Row included in that. Kingfisher, which is more or less like, I describe it like Lowe's or Home Depot in the UK and Europe, France and Poland as well primarily. So yeah, I just, again, I think it was fair value. I don't think I got a particularly amazing deal here, but I'm fine selling flat if I think I can sort of use it to buy cheaper looking shares, and that was the same decision here. Home Depot wasn't originally expected to be a trade, but it ended up being a 3-week trade. However, I did actually quite well on it, made like 5% profit, as I've already touched on. So again, I was absolutely fine with this. I think I described, when I first got into Home Depot, I described it as a great company at fair value. I sold it above that, so okay. And, you know, I would absolutely be tempted to buy into Home Depot. It's just at the moment it's kind of holding up relatively well and other things look cheaper. But I would absolutely consider Home Depot, especially under about 250. I think you can still, I mean, to be honest with you, anything under sort of 300 doesn't feel dreadful in my opinion for Home Depot. But 250 in this market would be where I would like really get excited again to re-enter into it. So that's my feeling there. And last but not least, this is Google. This is more about admin, and you know, I mentioned on my buys about sort of Microsoft and Apple and also Amazon being a bit bigger in terms of buys this week than you might expect for the averaging in. That was basically because I sold my averaging in position in Google, but it's also a reflection of the fact that I have a big Google in my other portfolio where I've just been buying. So I had like Google Class A where I've just been buying opportunistically, and Google Class C where I've been averaging in, but I decided to sort of simplify that. So I now have Google Class A about 2.5% of my portfolio at a really good buy price, something like 21.50. So that's fine for me. And Google here I redistributed among the other big three, so Apple, Microsoft and Amazon. And again, for anyone who's new, my position here is that, especially with Microsoft, that they're never cheap, but they're arguably the best quality company you can invest in. And likewise with Amazon and Apple, I just don't really expect them to be going anywhere. I think the buys at the moment are perfectly fine as well, and I just want long-term exposure to what I think are three companies that will be there for a long time. So that's it is mostly about admin. I've been buying Google Class A in my other portfolio and decided that I didn't really want the dual exposure. So that's the thinking there. Anyway, that's all my buys and sells over the last couple of weeks, but let's have a look at my portfolio performance because it's pretty gross, but I think it's important that we're transparent when the market's going down. So let's have a look at that now. All right, so yeah, this is my portfolio. It's not quite week on week, right? Because the last time we updated was the 3rd, now it's the 17th. But I mean, it's literally all red, except Evraz, which is only not red because it's been frozen as a Russian miner. So that's actually somewhat amazingly my best performing asset of the week, and that's only because I can't do anything with it and it can't move. So that's funny in a way. I'll start with the solds. Obviously, this is going to mirror the 4 out of 5 on my sold bit a moment ago. The trading here, just basically I sold everything, right? So I no longer have a position in those, so that's why they won't appear there next week. Basically the greens here are the ones that I want to talk about, but if anyone has any questions about the others, then feel free. So for the first time in a while, I bought some Games Workshop shares. They actually sit outside of my tax efficient ISAs, more or less in sort of a fund if me and my wife need the money. Games Workshop have been really beaten up. I have a price here in the low 80s, so it's very red actually, and you know, it's down 17% my position just over the last fortnight. I think the Games Workshop at the moment represents value. It's trading in the PE of like 16.2, I think is the analyst consensus. I think it's a real high quality company. It's definitely had some issues transitioning to becoming a multinational, as well as freight costs and sort of getting their IP arm up and running. But I think their IP this year is really going to shine. They've got a lot of good stuff coming through. And also now they've really sorted their distribution centers, particularly in America, where there was a relatively large backlog for a company this size. Also, as well, I would say the product effectively is absolutely compelling at the moment. I've got quite into it. Despite just being an investor, I have become somewhat of a fan. I think it's really good and exciting. And you know, they're working on scripts and stuff as well, just to bring this even more into the mainstream. So I continue to like it. There are some concerns around this that I've spoken about in a dedicated video, so feel free to check that out. But for me, I think it's actually verging on a really strong buy at the moment for a company that enjoys bigger margins than Google by some margin. So, you know, this is a company that just is able to print money and it's very efficient. Some of its return percentage ratios are just some of the highest I've seen. So I think kind of people are sleeping on it a little bit. Yes, it had been expensive when it was trading in the 30s, but now it's had a reality slap that I think has just been overdone. So I am back to buying Games Workshop. Hollywood Bowl I wanted to talk about. So this is it's still a very strong performing share for me, just because actually my trades here have been very good. I've had as many as 5,000 shares in Hollywood Bowl. I currently have 1,500, and I've more or less sold twice very close to the top, which close to the top was about 5% less than my fair value. So that felt very timely. I'm more or less flat on it in terms of my unrealized position at the moment, but my realized means I've made about £2 profit. I continue to buy this, and that might look a little bit spicy when you think about sort of cost of living and all the rest of it. But for me, bowling still represents a great family value as a day out or some time out. I think Hollywood Bowl is basically best in class. They've started to expand internationally into Canada specifically. And I am betting that bowling specifically, but Hollywood Bowl in particular, is going to continue to attract spending from kind of limited spending that people have. I think it's a good choice. And Hollywood Bowl, I spoke about it before when I reviewed them specifically. They are surprisingly digital as a bowling alley. Like, this isn't an old stuffy bowling lane, right? These people have really put a lot of time into their mailing lists, into their upsells, into really understanding their spend per customer, kind of making sure they're diversified. I just really like everything I'm seeing. It's a small cap, 400 million or so market cap, but really great, well-run business. So I really like Hollywood Bowl under about 230, even 240, but under 230 for me becomes compelling. So I am buying just because I think that has about 30% upside at the moment. Next up is Amco. Amco really crashed this week. I'm not really sure why. It's, again, not a huge company, but it kind of operates in the middle of the supply chain, more or less. It does sort of some of the more advanced packaging, testing, verification, that kind of stuff. So it's less cyclical than many of the semis. Also as well, I think this company is much improving all the time. They've got additional production facilities opening in I want to say it's Vietnam. I think it's Vietnam. Now, I do expect their Q2 to be more or less flat based on the Shanghai lockdown, which will influence, you know, it's about 15% of their output, which has been locked down now for a good quarter. So I'm more or less expecting Q2 to be flat year on year. However, I'm expecting the overall EPS to be significantly up. And right now, the 2022 forward PE for this company is in the 5s. You know, something like a 320 EPS, and the share price is like $16. So to me, this is, I mean, I don't really understand. I mean, maybe because I'm newish to investing, I haven't really seen PEs get this low for what I consider are perfectly fine companies. But for me, this is, despite the fact I already have a large position in this company, I bought another 30 odd shares, and I feel really good about it. So fine. And then last up, I just want to talk about Kingfishers. So I opened a very small position in Kingfisher and, you know, added quite significantly to it, more than doubled my position. This is a company that's also had a difficult couple of years, especially on its continental Europe side of business, but it seems to be really finding its feet again. But the PE hasn't really caught up. It's also got a very good yield at the moment, over 4%, PE in the 6s, I think. And for me, buying under 250 pence is really good. So I brought my average down quite significantly by doubling here, and I'm only actually down a couple of percent just because, yeah, I'm relatively new to the position and it was quite small. So that's how we're currently looking at the moment. So yeah, unfortunately, I'm literally red across the board, other than the shares which are frozen because of the conflict in Ukraine, which is bizarre to think about. But yeah, that's kind of how I'm feeling. I won't lie and say that I haven't found the last couple of weeks difficult. Like I say, especially on Thursday, I think it really kind of was like, but then, you know, I got a sense of perspective, thought about why I'm doing this, thought about how fortunate I am that I can do this. And sort of was like, right, you know what, like, this is great. Like, I'm still 2 decades away from retiring. I'm now buying shares that I would have paid 20% more for. And this is really great stuff, right? So I'm kind of trusting the process. I'm really committed to it at this stage. I'm not kind of changing my investment strategy or anything like that. Continue to add sort of $3 a month into the portfolio. And you know, and again, for anyone who's new, my wife's about to start a new job in private equity, so in about 6 weeks I'm going to have restricted trading. So in advance of that, I'm basically making sure I'm happy with my portfolio. So again, there's some movements here as I sort of redistribute, especially lean a bit more into America at the moment to get my portfolio to about 50-50. But you know, these companies, even though some of them are looking cheap and maybe they're involved in a turnaround or recently improved or etc., I basically believe in them. And this is a pretty material part of my wealth. So you know, I have to be convinced in order to be making moves, especially when it's running against the narrative of the market more generally, because the market's gross at the moment, but specifically with MPW, which again is definitely attracting some bears at the moment. I think that's everything though. So yeah, big long video this week, 2 weeks worth though, so hopefully that was interesting. Any questions, obviously drop it below. Thank you very much for watching, everyone. I've been the Boss Hog. Good luck with your investing, and I guess good luck and stay strong mentally as well. Thanks very much, everyone. Bye for now.